The queue starts forming before sunrise. People are standing outside a locked bank branch with envelopes of documents they no longer trust. Inside the building, the lights are on, but no one is answering questions. ATMs display error messages that were never part of the user manual. Accounts still exist on screens, yet withdrawals are limited, delayed, or suspended. Prices in the street market across the road are changing faster than the notices taped to the bank door. In moments like this, people discover a distinction they were never taught. There is a difference between owning wealth and being allowed to access it. This scene is not hypothetical. It has occurred in Argentina, Cyprus, Lebanon, Greece, Venezuela, and dozens of other economies across the last century. It does not require war or revolution. It only requires a loss of confidence in the banking system's ability to meet its promises. When that happens, rules change overnight. Contracts are rewritten by emergency decree, and the assets people believed were safest become conditional. Today, the global financial system is larger, faster, and more interconnected than ever before. Digital balances move at the speed of light. Liquidity is engineered through central banks and derivatives, yet the fundamental architecture has not changed. Banks still operate on leverage. Deposits are still liabilities of the institution, and access to money still depends on permission. By the end of this video, you will understand what banks can freeze, why they freeze it, and what historically has remained accessible when everything else is locked. You will understand the difference between nominal ownership and functional control, and you will understand the one category of asset that has repeatedly survived banking freezes, capital controls, and systemic resets. To understand this, we need a simple mental framework. Financial collapses tend to unfold in stages rather than explosions. The first stage is stress, where liquidity tightens and rumors circulate. The second stage is restriction, where withdrawals are limited to prevent bank runs. The third stage is suspension, where access is frozen to stop the system from bleeding out. The final stage is resolution, where losses are socialized, currencies are adjusted, and rules are rewritten. At each stage, the value of an asset matters less than its accessibility. In the first stage, most people still trust their balances. In the second stage, trust shifts to urgency. In the third stage, survival replaces optimization. History shows that during these moments, wealth does not disappear evenly. It concentrates in forms that do not require intermediaries. The first claim is simple. Banks can freeze claims, not objects. A bank deposit is not money stored in a vault with your name on it. It is a claim on a balance sheet. That claim is subject to the solvency of the institution and the rules of the jurisdiction. When banks freeze accounts, they are not taking wealth. They are suspending claims. This mechanism was visible in Cyprus in 2013. During the banking crisis, depositors woke up to find their accounts inaccessible. Withdrawals were capped. Transfers were blocked. Some deposits were converted into bank equity by force. The money did not vanish, but access to it did. Those who held wealth entirely as bank balances became illiquid overnight. The modern example is Lebanon. After 2019, banks imposed informal capital controls. Depositors could see their balances, but could not withdraw dollars. Local currency withdrawals were rationed and devalued. Wealth existed on paper, but not in practice. The limitation was not legal ownership. It was physical and transactional access. The risk here is often misunderstood. People assume that deposit insurance eliminates this problem. Insurance addresses solvency after resolution. It does not guarantee real-time access during crisis. In most historical cases, freezes occur before any insurance mechanism is activated. Time, not legality, is the constraint. The second claim follows directly. Assets that depend on centralized ledgers are vulnerable to centralized freezes. Bank accounts, brokerage accounts, pension accounts, and custodial assets all rely on permissioned systems. These systems function perfectly until they do not. When stress peaks, authorities prioritize systemic stability over individual liquidity. Argentina demonstrated this in 2001 with the Corralito. Bank withdrawals were limited to prevent capital flight. Dollar deposits were forcibly converted into pesos. Savers who thought they held stable currency learned that the unit of account could be changed by decree. The mechanism was not theft. It was redenomination under emergency powers. A modern parallel exists in digital brokerage platforms during market stress. Trading halts, withdrawal delays, and settlement extensions appear precisely when volatility spikes. Again, ownership is not revoked. Access is postponed. In crises, postponement is often equivalent to loss. The limitation is that even decentralized-looking assets can be centralized in practice. If custody is delegated, control is delegated. The system matters more than the label. The third claim introduces the core subject. Physical bearer assets do not rely on institutional permission to exist or move. They can be hidden, transported, exchanged, or stored without ledger approval. Historically, one asset in particular has occupied this role across civilizations. That asset is physical gold held outside the banking system. This is not a claim about price appreciation. It is a claim about access continuity. Gold has survived currency, collapses, regime changes, and banking failures because it is no one else's liability. It does not require a clearinghouse. It does not require electricity. It does not require trust in a counterparty. If you've never thought about access risk before, this channel exists for exactly that. During the Weimar hyperinflation, gold coins and jewelry circulated as parallel money. Paper marks lost value daily. Bank deposits became irrelevant. Gold maintained exchangeability because it existed outside the collapsing system. In Argentina, families who held gold jewelry could trade discreetly during the Corralito. In Lebanon, physical gold dealers continued operating while banks restricted withdrawals. In Venezuela, gold mining and gold barter emerged as the believer disintegrated. The pattern repeats not because gold is magical, but because it is structurally independent. The economic mechanism is straightforward. In a crisis, the state asserts control over financial channels. Banks comply to preserve solvency. Assets that cannot be digitally frozen fall outside this perimeter. They may be taxed, regulated, or restricted later, but in the acute phase, they remain accessible. The limitation is obvious and important. Physical gold is a liquid at scale. It carries storage risk. It can be confiscated under extreme regimes. It is not immune to price volatility. Its advantage is not safety in all conditions. Its advantage is survivability during access failures. At this point, it is worth stating what this channel is about. This channel focuses on financial forensics, studying past system failures to understand what survives. The fourth claim extends the concept beyond gold. Any asset that is bearer-based, portable, and not dependent on institutional permission shares this property. Historically, this has included silver, gemstones, and certain forms of cash. In modern contexts, it includes carefully managed, self-custody digital assets. However, the distinction is critical. Self-custody is not a slogan. It is an operational reality. If private keys are held by an exchange, access can be frozen. If keys are held by the individual, freezing requires physical coercion rather than a keystroke. Historical evidence for this distinction is emerging rather than complete. In countries with capital controls, peer-to-peer digital asset usage increases when banks restrict withdrawals. The mechanism mirrors gold's role in earlier eras. The asset bypasses the banking perimeter. The limitation is that digital systems introduce new dependencies: electricity, networks, and legal risk matter. Self-custody requires competence and discipline. Mistakes are irreversible. The survivability advantage exists only if operational execution is correct. Now, we need to contrast this with what fails. Bank deposits fail in access before they fail in value. Bonds fail when issuers restructure. Equities fail when markets close or dilution occurs. Pensions fail when contributions are locked and payouts delayed. Insurance fails when claims processing lags reality. None of these failures require malice. They are structural. They emerge from leverage, maturity, mismatch, and political incentives. The system prioritizes continuity over individual immediacy. In every major banking crisis, authorities face the same trade-off: allow unrestricted withdrawals and collapse the system, or restrict access and preserve the core. History shows which option is chosen. Today, there are signals worth observing. Global debt levels are higher than at any point in modern history. Banking systems are more interconnected. Liquidity relies heavily on central bank intervention. Digital currencies increase efficiency, but also centralize control. At the same time, capital controls are no longer theoretical. They are openly discussed as policy tools. Withdrawal limits have been normalized during stress events. Negative real interest rates quietly transfer purchasing power. None of this guarantees an imminent crisis. but it does clarify the incentive landscape. When stress appears, access will be managed. Permission will matter. The practical synthesis is not to abandon banks. Banks are efficient for transactions, credit, and daily life. The synthesis is to separate convenience from survival. Transactional capital lives inside the system. Survival capital lives outside it. This does not require extremism. It requires proportionality. It requires understanding that diversification is not only about asset classes, it is about custody and access pathways. The one thing banks cannot freeze is an asset that does not sit on their balance sheet, does not rely on their ledger, and does not require their permission to move. Historically, physical bearer assets have filled this role. Modern variants exist, but the principle remains unchanged. Return now to the locked bank branch at dawn. Some people are waiting for permission. Others are already negotiating elsewhere. The difference is not intelligence or morality. It is structural positioning, decided long before the crisis began. Financial systems fail in predictable ways. Access is always rationed before value is reset. What survives is not what yields the most in good times. It is what remains reachable when the doors are closed.